Since the EU referendum vote that has seen the UK begin the process for exiting the European Union, much has been talked about the banking sector. We're focusing now on the European banks that will now be operating outside of a unit which includes us here in London, however that form takes place. Chris Tinker joins us now from Libra Investment Services. What does the European banking sector look like? What is it moving into now in this new era where it looks like London will ultimately end up being outside of the EU?
Well, I think the first thing to say is the immediate reaction last Friday and at the beginning of this week was an overwhelmingly negative one, particularly towards the banking sector in Europe. Obviously, UK banks are part of that, but I think the broader message was that if anything's going to have to act as a shock absorber for change, it's going to be the banks. But when we look on our systems, on our valuation model Apollo, on what that tells us from a value perspective, even the extent of those 16, 17% moves last Friday in the sector, even with that move, it didn't take banks into deep value territory, which tells us something else is going on in the banking sector in Europe. We saw the sell-off because as one of the sectors in the market where value is still in decline, we've got a downward trend in value, and against that backdrop, any shock like this or any uncertainty like this will just extend the discount, if you like, that the market feels it needs to have against the value of those assets. And what that meant was that the banking sector took the full hit. Clearly, the recovery that you saw on Monday with the Spanish banks was a relief post-election there, but the broader message is widening out. It's not just the EU relationship with London that's at issue. It's the realisation that we do have this month now, we do have the reality of new stress tests from the ECB. And when you start to look just below the surface at what's going on, for example, the Italian banks and the Italian banking system, all of those EU structural concerns associated with the banking sector are still there, and that's really the issue that we have to face the European banks right now.
The thing about the Italian banks is they need more money. That's the bottom line, don't they? How are they going to get that in the EU structure?
Well, this is a real problem now. What the Italian authorities have faced up to is that the small recapitalisation processes, the bailouts of regional banks in particular going bust, there just isn't enough money there. They've got this Atlas fund of 40 billion euros. There's nowhere near enough when you've got probably provisions bad loans of 200 billion euros or more in the Italian banking system, half of which possibly aren't even covered. So unless you indulge in some kind of state bailout, which the EU rules won't allow, you're going to be forced down this route of getting bondholders to bail in. And of course, in Italy, a lot of those bondholders are retail. A lot of those investors are in politically sensitive areas in Italy. You're in the conundrum of actually knowing what you need to do but not being able to do it. And because that situation hasn't changed, even though government bonds in Italy are barely yielding positive returns, you still have this fundamental structural impasse in the financial system. And that's one of the reasons that Italy is in deflation, why Italy has got the structural unemployment issues that it has, is that the financial system just doesn't work in the country.
Yeah. What about banks that operate in Europe that have exposure to London? I'm thinking about the big ones, the Deutsche Banks, the Commerzbanks, the UniCredits in Italy. In Spain, you've got the likes of Santander with big operations here in London. How is the divorce between London and the rest of Europe going to affect their operations in London?
Well, the first thing to say is, if you were thinking in regard to the passporting capability would require you to have a branch in an European Central Bank country area, under a bank operating under the ECB, which of course the Bank of England currently is, but won't be in future. Well, all these European banks have already got that structure, so that's not irrelevance. That's an irrelevant fact for them. What it does mean, though, is are they going to be minded to try and retrench some of their operations back to their European banks for political or cultural reasons? Well, we've seen what's happened in the past is that you don't have the depth, liquidity, resources, people and infrastructure in continental European financial centres that you do in London. So there's very little impact that you're going to have from a structural point of view, in my opinion. And actually the bigger issue is these countries will want to keep, and these banks will want to keep their London operations intact, because this is where the expertise lies for them to be able to do the capital markets activity that they currently are doing in London, and their own domestic companies will still want them to be doing post EU, the UK leaving the EU.
So in the brave new world, you don't really, all other things being equal, you don't really see things changing very much.
Well, I think what changes is that regulation is changing all the time. We've got the migration of new MiFID II regulations, which will cover an awful lot more of the regulatory infrastructure. But bear in mind too, if the UK...
But MiFID sits over the EU, doesn't it? It's a bigger umbrella.
Yeah, it's a sort of a pan-galactic umbrella for operational regulatory guidelines, if you like. But actually, the other thing to recognise is that when you're looking at the regulatory regime you're operating in, the EU has wanted to introduce a financial transactions tax. It's wanted to introduce a banker's bonus cap. Now, if the UK is not going to be introducing those elements, which it said it won't, then suddenly the argument for a financial transaction tax in Europe looks untenable. So the UK authorities have made their position clear. Europe's now going to decide what it wants to do, because far from seeing a problem, if you tell European operating entities they've got to pay a financial transaction tax, but London says you don't, which direction is the flow going to go? It's a very straightforward analogy. So it's not all one way, and that's the really important thing. When we've been talking in the wake of the referendum, before the referendum it was all about the UK-centric focus on what's going on in Europe. We're now just beginning to realise that Europe's going to have some major problems without the UK in the EU. The European financial services industry is going to have some major problems working out how it operates in conjunction with a massive entity offshore that won't indulge in all of its rules and requirements, but will operate at a regulatory level where it cannot be discriminated against by continental Europe. There was a big sucking sound out of continental European financial systems over the last 10 years, particularly as London became this really increasingly focused global hub. That isn't changed by this. If anything, it could accelerate the process in some areas. And with the problems you see in the regional banks in Southern Europe in particular, there's some major consolidation problems that European banks are going to face existentially now, even with the UK still in Europe. So when you're preparing for the future as a European bank, the real problem is what you're left with, not what you're losing.
It's all part of the massive mix of arguments and debates that will be held out about Europe. But Chris, in the meantime, thanks there for joining us. Chris Tinker is founder and partner at Libra Investment Services.